Hello, I'm Michael Long. Welcome back. Today I want to talk a little bit about some mutual funds. Anyways, this ought to be a relatively interesting chapter for you. Certainly things that you can apply to your own personal investing in the future. Basically a mutual fund is a pool of money that lots of different investors can come together and put together, and they'll turn around and reinvest that money with a specific type of strategies. All different types of mutual funds that you can read about in your textbook. Obvious things are, for example, you can have bond funds where the company goes out and buys a variety of levels of different bonds from different corporations. It could be a corporate fund, it could be a government bond fund, it could be a long-term bond fund of 20 to 30 year average maturity. It could be relatively shorter term, maybe it's 4 or 5 year average maturity. There's just about anything you want, you can just about find in the form of mutual funds. Equities, you can have high growth funds where they're paid very, very little or to no dividends at all. You're going to make your money through price appreciation. You might have something that are, maybe they actually going to pick stocks that have just pay relatively high dividends. So you can buy funds that meet that. Sector funds, one of the more risky type, tends to be a little riskier than just general funds because it's going to segment out different sectors of the economy, whether it's like gold or natural gas or mining or utilities, insurance. There's all different types of things that you can purchase from that. So real quick, Ray, I want to look through a few things first here. How is a mutual fund valued? So I want to talk first a little bit about what we call a net asset value. That's literally the underlying value of the fund. So the way you would determine that really, I set up a simple example. Suppose we had a mutual fund that held 3 stocks, stock A, stock B, stock C. The number of shares they held in each particular stock was 2,000 shares of A, 1,500 shares of B, 4,000 shares of C. Here's the underlying price of the stock. And so to get the value here, of course, all we're doing is multiplying each of these and coming up with the underlying value or the market value of the assets that the fund is holding. In this case, we're holding all stocks. The total market value of this is $625,000. Well, mutual funds are going to have expenses associated with it. So what we need to do is subtract out those particular expenses. So a net asset value will be the market value of the underlying shares minus any liabilities the company may have. Trading costs, running the office, salaries, there's different type of operating expenses that need to be taken out of this number. Then we're going to want to put this, so this is the net value here, but we want to put it on a per share value. Now we want to divide this through by the number of shares that the mutual fund has outstanding. Now, this number really has nothing to do with these numbers right here. This is the number of shares of individual stocks that they're owning, okay? But the mutual fund can issue as many shares of its underlying stock as it wants to. So these shares outstanding here, we're going to say it's 50,000 shares, have a claim on this money. So we want what's their claim? Well, on a per share basis, if we subtract it out here, what we find is 625,000 minus their liability divided through by 50,000 gives us a value of $12 per share. So why would we want to buy mutual funds in the first place as opposed to just going out and buying individual stocks? What are some, let me just go through and just list a few of the type of benefits associated with mutual funds. Let's just take a look at them. First of all, one of the biggest benefits right here is diversification. Okay, you're going to get, we'll talk about this as we go through the semester. In other words, diversification lets you spread your risk out across many, many assets. If you have $1,000 to invest, okay, you can certainly, $1,000 is going to cost you $12 a year. In this case right here, what do you get for the $1,000? You're going to get 3 different stocks, okay? So, and in a typical mutual fund, you might have hundreds of stocks in there. And so you can take small amounts of money and it allows you to invest and get great diversification. In fact, where you spread it'd be very difficult to spread $1,000 across, even 3 or 4 stocks, much less 100 stocks. But this will allow you to do that with small amounts of money. Another important thing is professional management. Okay? Do you really have time to go out and manage your money? And it takes a lot of work and a lot of effort to read up companies, to study them. Where are you going to put your money? Should you pull your money out? How are you going to do that? Well, you have professional managers in the fund itself. That's what they do. That's all they do. You pay them a fee to do that. That's part of the liabilities right here. This right here is net of all the liabilities associated with the management fee. So you're going to get expert help up here in this case right here. Another good thing is record keeping. They'll help keep track of, so for example, you'll get a statement at the end of the year. How many dividends were paid? What was your capital gains? Which of those capital gains, what were long-term gains? What were short-term gains? Because it has different tax effects. Are the dividends you received, are they qualified dividends or not qualified dividends? Again, it's going to affect your taxes that are going to be paid. Another item here is typically you're going to get lower transaction costs. Okay, lower transaction costs to carry out large trades than you. So for example, just a simple example, if you have I have a Fidelity account. If I were to come up and go out and buy 100 shares of stock at $50 a share, it's going to cost me, well, it's $5,000 expenditure. It's going to cost me about $8 to do that transaction. If I were to go out and bought 10 times that much, instead of $5,000, spent $50,000, what was it going to cost me? It would still cost me $8 for the transaction. So from that perspective, when the corporations are buying large amounts right here, their overall transaction cost as a fraction of the amount that they're investing is going to be much smaller than what you could expect to pay on your own. So these are some of the benefits that you can gain, and a few of the benefits anyways we can gain from actually owning a mutual fund. Now, just real quickly, I want to talk about two basic type funds. One is called an open-end fund, and the other is called a closed-end fund. Okay, so an open-end fund, I'm going to sort of do a comparison and contrast right here. An open-end fund shares outstanding are sort of flexible. In other words, the number of shares outstanding for an open-end fund can go up and go down. If more people want to buy that fund than sell it, then the number of shares outstanding will actually climb. If more people want to sell the fund than buy it, the number of shares outstanding will actually decline. So what's kind of driving that right there? Well, when you buy and sell a stock, shares from an open-end fund, you're really buying it directly from the fund itself. Okay, so up here, the shares outstanding are purchased or sold back to the fund. Okay, they're purchased or sold back to the fund. So really, shares outstanding is dependent upon demand. The more people want, the more shares there are. The less people want, the less shares there are. So the supply of shares is going to be dependent upon how much people want to buy. Well, since you're buying and selling directly from the fund, okay, there's no need to trade on an exchange. Okay, now from your readings, you should know an exchange or buying and selling a security in the secondary market, like the New York Stock Exchange or the NASDAQ or over-the-counter stocks. There's really no need for that. The exchange is there to do what? To bring buyers and sellers together, a place that they can meet and know and do transactions. We don't need that You're buying and selling directly from the fund itself, okay? Because the fund does this, because the fund stands ready to repurchase the shares or sell new shares, what do they sell them for? Well, they're going to buy and sell shares at the net asset value. Okay? At the net asset value. That's what you're going to be able to look for. Okay? So it's not going to trade at a premium or discount to this right here. Now let's go on the other side here. Let me draw a little line of closed-end funds. Closed-end funds have fixed shares. Okay? The number of shares that they issue, once they issue those shares, that's it. This number is fixed. If they issue 1 million shares, then there's 1 million shares. That's all there is. So what happens if you want to buy and sell this particular a closed-end fund? Well, if you want to buy or sell a closed-end fund, if you want to buy it, you can't buy it from the fund. You've got to find someone who wants to sell. Okay? If you want to sell your shares of a closed-end fund, you've got to find somebody who wants to buy. Where do we do that at? Well, we do that at an exchange. Okay? So this right here, these shares will trade like a stock. Okay? They trade on an exchange. Okay? And again, the reason they need to trade on an exchange is if you're a buyer, you need to find a seller. If you're a seller, you need to find a buyer. Okay? So what is going to be dependent on demand and on this time? Supply is fixed, isn't it? The amount of supply of shares on this right here is fixed. Okay? So what's going to have to give? And what if a lot of people want to buy this fund? All of a sudden there becomes a huge demand. Everybody wants to buy this fund. Well, there's only so many shares to be bought. How do you entice people to sell your shares? You're going to have to raise the price. So what's going to happen down here, price is going to be dependent upon demand. Okay? Up here, shares outstanding was dependent upon the demand, not price. This is fixed, so this is going to be what's going to happen. So it's possible. Okay, so price of the fund may sell at a premium or discount to net asset value. It's a big deal here, okay? So in other words, the net asset value, remember, is the underlying value of the stock. And basically, you can think of it this way. If a company sold all their shares of their outstanding assets, paid off all their liabilities, and whatever they have left, they divided it up among the shareholders, that's in essence what net asset value is. So what we're saying here is because price is going to be dependent upon demand, since this is fixed, it's possible, a lot of people wanted this particular fund, it's possible that they can sell at a price above the net asset value. If people don't want this share, it's possible it could sell below the net asset value. That's not really true over here, okay? Again, you can think of this, let me just put a little quick, a little diagram over here. Over here, I told you, how many shares are outstanding over here? The number of shares outstanding over here, as is the supply of shares, is as many or as few as you want. If people start selling the security, the shares outstanding will fall this way, okay? It just gets smaller. If people want to buy it, it goes this way. So on any given day, okay, if we're sitting here, if there becomes a great demand for this particular mutual fund, the amount people want to buy, well, they just issue more shares at this fixed net asset value, okay? So the price that you pay is whatever the net asset value is, because they'll issue as many shares as they need to. If they're here and people sell the shares, all they're going to do is sell the underlying value of the stocks that they're holding and take that money and repay the people at the net asset value, okay? It's not going to matter. But over here, What's fixed over here? The shares outstanding is fixed. The supplier out is fixed. Okay, that's what's fixed. So in this case right here, on a given day, if you have demand changing, if people all of a sudden started having a higher demand for this thing, what's going to give? Well, maybe this is a fair net asset value, but if a lot of people want to buy this stock, this mutual fund, it could very well sell at a price above net asset value. If all of a sudden people said, no, I don't want to hold it, people's demand for it falls and people start dumping it and trying to sell it, okay, then the price might actually be below net asset value. But that's sort of just a quick diagram of how this will kind of work and give you a little idea of this. Most of this you should be able to pick up from your readings in your textbook, but I want to spend just a few minutes here just doing a little bit of a compare and contrast with these. Now, one other thing too about an open-end mutual fund, you can these funds can sell with what we call a load or a no load. Okay. Okay. A no load fund basically does not, there's no fees to buy or sell, okay? There are no fees to buy or sell. A load fund, a fund that has a load associated, the load is going to be a particular fee. It could be what we call a front-end load, and a front-end load, this is a fee to buy, okay? So if it has a front-end load, if you paid $100 for this fund, okay, and there's a 3% front-end load, you're going to pay $3 is going to go towards this purchase. So when you send $100 into this company, $3 of it they keep, so basically you're going to buy about $97 worth of stock in this case right here. Who gets this? Why would they do these loads? Well, these loads are paid usually to as commissions to people selling the funds for them over here. And that's what the purpose is. You'll get brokers like, for example, Edward Jones, I think American Express has a company too that does financial advising and things. And so when you go to these type of companies, they're going to probably put you into a mutual fund, most likely, that's going to charge a fee. That's how they make their money, which is fair. You know, you don't get advice for free. In this case right here, they're helping you manage your money. The other side is what they call a back-end load. Okay. And a back-end load is basically sort of a deferred sales charge. Okay, this is a fee charged when you sell it, okay? So you don't pay anything to initially buy it, but you pay when you sell. One thing about the back-end loads, these loads usually fall the longer you hold, okay? So, for example, maybe this has a 3% load. If you sell any time in the first year, you're going to pay 3%. You sell any time in the second year, you pay 2%. You sell any time in the third year, you only pay 1%. And if you hold it longer than third year, for 4 years and on, you pay 0%. What is it doing? It's encouraging you to buy into the fund and don't churn it, don't buy and sell. These type of funds here, mutual funds were not made to be traded really on a day-to-day type basis. But these are some just different types of funds that you will encounter as you go through in your investment board. Just wanted you to be aware of. But look through the terms and things in the textbook and based on the information you're getting right here as well. One last thing I want to go ahead and put into this video and talk about out of this chapter is looking at a rate of return. The rate of return you shown in your textbook, they usually use net asset value. I don't like to use net asset value because it excludes, for example, It's fine for an open-end fund because net asset value is when you buy and sell at net asset value. That's not necessarily true, we said, for a closed-end fund. So for the return on rate of return, I usually like to write it this way. Let's put P1, I'm going to write it this way. We're going to assume you bought it today and sold it 1 year later. So the amount of money you would earn in that case is the price you sold it for minus for the price what you paid for it. Now the mutual fund could have what we call cash distributions. These cash distributions would be, for example, during the course of the year, the stocks that they own pay dividends, and they'll take those dividends and they'll pass them on to you. Now, again, record keeping keeps track of what is dividends and what isn't. Sometimes they might actually go and sell underlying shares of stock. They're taking the profits. Maybe a stock has gone way up, it's doubled in price, and they go and sell half of the shares. Well, that's a capital gain. They're going to pass those on to you as well. So when I'm putting cash distributions here, this could be both dividends, okay, and it could also be capital gains from sales of underlying securities. And this will be divided through by the price that you pay. So I like to write it in this way. It's a standard thing, a standard rate of return here. If it's an open-end fund, this price 1 would be net asset value 1 minus net asset value 0 divided through by net asset value 0. That's kind of the way your book shows it, but usually I'll put some questions on quizzes and things like that and tests that's going to pick up and have you calculate rates of return on a closed-end fund. And on a closed-end fund, you cannot necessarily use net asset value because it might be selling at a price of a premium or discount to that. So you need to be aware of that. Matter of fact, the price for a closed-end fund, let me go ahead and put this here to you, as well as let me work some example problems in the chapter, would look like this. So a price on this right here, I would say, let's say the price, the current price in year 0 is going to be net asset value. It's going to be based on this way. We usually refer to this whether it's selling at a discount or a premium. So it'd be 1 minus if it's a discount, or plus if it's a premium, right? So if selling at a 5% discount, it becomes 1 minus 5%, or if selling at 8% premium, 1 plus 8%. Let's take an example. Let's say this is net asset value is $70, and let's say it's selling at, let's go ahead and say it's selling at a 5% discount. So you write it like this: 1 minus 0.05 is selling at a 5% discount. So you're basically doing what? You're buying at 95 cents on the dollar. This is equal to $66.50. That would be the price. This is the net asset value, but you'd only paid $66.50, 5% less than this number right here. Okay, another example we use it here. What if it's selling at an 8% premium? Okay, in this case right here, it'd be 1 plus the premium, 1 plus 8%. Notice I'm putting these things in decimal numbers. So this becomes 70 times 1.08, $75.60. In other words, it's selling at what? 8% higher than the $70. So this is kind of the way you would write this. And again, so what if you bought this particular mutual fund here when it was selling at initially selling at a 5% discount, and you bought it for $66.50, you sold it later at an 8% premium for $75.60. Net asset value, then let's say it didn't change at all. It's possible, but this is what happened on this right here. So this becomes what? $75.60 minus $66.50 divided through by $66.50 here as well. If during the year it had cash distributions, maybe it had distributions of $2.50, we put these in here. So we put this up here, $75.60 minus $66.50 50, over top of 66.50, and gas distributions, I said was 250. Let's add this up. Let's go ahead and go ahead and finish out this. So 75.60 minus 66.50, $9.10 in capital gains. Add $2.50 here for the cash distributions that you received. That's $11.60 for this top part, divided through by 66.50. That's initially what it cost you. Making the division, that is equal to a 17.443%. That's your rate of return off of this particular example right here. Okay, so take a look at some of the problems in the back of the chapter that's assigned to you. Again, if you have any type of questions, feel free to ask on the discussion board under Ask the Professor, or you can send me an email, or if you really need to, you can give me a call, send me a text, whatever. Until then, thank you very much.